investing in stocks is always a game of at least 3 years and longer. Hey, what's up you guys? Lukas here from xlwealth.com. Now in today's video, I want to go through the beginner investing steps, what you should do, when to pick which stocks, how to know which stocks you should pick that will make money on the long run, of course, for you. But if you're a beginner investor and you'll still be thinking, what stock should I pick and how do I pick my first stock? Well, the first thing that you always have to remember is that money on the stock market is always made on the long run. If you think like, I want to make some money within 1 year and then, pull the plug again, then I'll tell you this, that's not going to happen in the stock market. Yes, you could have your one-time wins. Yes, you could. Not very often. So we don't have these stock market crashes all the time. Okay, so in this video, I want to go through the 3 investing styles that you could apply. 3 different investing methods in the stock market that I'm going to go through because these are the ones that I tend to apply myself. Okay, so the first one I want to go through is dividend stocks. So why is dividend stock so interesting? You got to really understand like this. The moment you buy a dividend stock, you can own a share of a company. Now you buy dividend stocks, for example, like on a whole share, and the moment you buy that stock, you own 1 share of that whole company. If that company has 1,000 shares, you buy 1 share, you own 1,000 of that company. Now, it's not that you can go up to the store and say, hey, I own your store for a 1/10, 1,000%. You can't really do that because it's only on paper. On paper, you own their company. The only thing what they do is they will issue a certain profit margin of that year's dividend stock. For example, they will give that to you. And they pay out, that differs really on a stock, for example, but they pay out monthly basis, quarterly basis, or annually basis. So that really depends. And in the end, it's always about the percentage. So it's about the percentage on how much dividend do you get the moment you buy their stocks. When we take a look at Apple, what you will see is their dividend stock. 1 stock, 1 share. If you would like to buy 1 share from Apple, it's valued currently at $383 per share. And the dividend, the amount of dividend what you get, it's 0.85% of dividend. So that means it will take you quite a long time to be completely paid back. But you gotta understand like this, the moment you grow over time as well, this could change as well. So the moment a dividend stock grows in price, your price will also grow as well. Your value will also grow. And that's the way how you grow your money in your portfolio over time as well. It's not about the 0.85% that's gonna make you rich. It's the thing that Apple will grow over time in value, and everybody wants this, and then your stock price will grow as well, and that's how your price and money will grow in your wallet. Now the interesting part is this, with dividend stocks, you do not have to do anything. It's on paper, you own a little piece of paper, you don't even get the paper anymore. You only buy on paper, so on your phone, for example, on Robinhood or on any app that you use, you buy a certain stock and all of a sudden you're owner of that stock the moment you invested that amount of money in them. And then you're an owner and they will pay you out monthly, quarterly, annually, depending of course on what their rules have written for you, okay? Now that's Apple. The interesting part is this, why is Apple such an interesting stock? If you take a look at the graph, you will see that all the companies that I go through are struck by the certain crisis that we had earlier this year. But there are companies, there are technology companies like Apple. Of course they're struck by the crisis, but they keep on continue growing, although the situation happened to them as well. Now this is the interesting part. It's very important when you're a beginner investor, know what to pick, which stocks will grow over time, which stocks are affected by a crisis, and which stocks should be totally fine. Now, if we compare this, for example, to Delta Airlines, Delta Airlines also one of the picks from Warren Buffett, of course. When we take a look at Delta Airlines, these stock prices were sky high. And if you would want to buy a Delta Airlines share, the price is only $27. Now you might be thinking, oh, that's not too bad, right? It's an airline. I could buy a share of an airline for only 27 bucks. But yes, and this is the interesting part. You got to see it like this. What happened back then, before the actual crisis struck, airline prices were at least double the price. It was over $50 per share. So what happened, the moment the crisis struck, there are not many people flying anymore. So what happened is that this price dropped terribly, and we are currently at $27. Now you have me thinking, oh wow. So is it a good time to buy Delta Airlines stocks now then? Well, that is something that you have to think about, because in the end, currently the dividend stocks of Delta Airlines is set at 5.94%, which is high for dividend stock. Now, yes, there are dividend stocks that maybe even pay out to 10 or 12%, but hey, the higher the payout, the higher the risk. This is why there is a high payout for this Delta Airlines, because most likely this might be a risky stock to pick in right now. And yes, if you take a look at Warren Buffett, if you take a look at what he did the last few months, is he started to sell off his Delta Airlines shares. If you want to buy dividend stocks, it's a great thing, but you really have to keep in mind, how sensitive is it to certain crises? Do we have to be careful about this? Now, the thing is, if you bought a lot of stocks valued at $50 or more per share on Delta Airlines, what would happen now is, of course, you lost half of the amount of investment that you made previously. And this is the interesting thing as well. If you wait another 10 years, most likely it'll have grown over time again. Because like I said, investing in stocks is not a game of 1 or 2 years. Investing in stocks is always a game of at least 3 years and longer, because then you'll see what the economy does and what happens in the stock market. Okay, that's a very important thing to remember. So these are just 2 of these examples. Now, what I find very interesting, so the moment I buy dividend stocks, so I'll go through 3 different methods, of course, in investing, but why I buy dividend stocks is I tend to buy stuff like P&G, which is Procter & Gamble. If you don't know the company, go Google it. Procter & Gamble actually has consumer goods, and consumer goods are good. So no matter what time you're in, no matter what kind of crisis you're in, we still need those consumer goods. We need shampoo to wash our hair. You need those creams for your face. You still need toilet paper. Yes, you still need that, but they make a lot of consumer goods. And consumer goods, if you take a look at P&G, of course, their stock is currently at $123, and they pay out a dividend of 2.55%, which is a nice amount, because you got to really understand like this. You buy their stock, and yes, they got struck by the crisis as well. And even if they got struck as hard, they grew back to the normal level as it was before very easily, because this is consumer good. The reason why I always buy Apple as well, it's because, you know, they grow over time so much as well. They grow. That's a growing company. That's what you love. That's what you want. So this is why the moment you want to buy into dividend stocks, is what you would like is buy into companies that have a great value, and the value still grows over time. And no matter what kind of a crisis we are in, these stocks will, you know, hardly be unaffected or slightly affected, but grow back to their original level. That's when you take a look at the value of a certain stock. This is very important. So I love to buy stocks that I know that will grow in value, Apple, or that will go back to an original level and always pay out a nice certain amount of money over time. And this is so important if you want to buy dividend stocks. You just buy a certain stock, and the only thing is what you do is you just wait. You just wait for their payout every month, every quarter, every year. The only thing what you do is just wait. Sit there and wait. Nothing else. It's simple as that. Now, if you want to know how I do my research, I've created a program that, of course, that teaches this, how to do research. But I'll go into that in a later video, okay? Not today, because otherwise this video will be super long. Number two that I would like to go into is the individual stock. Now, we were already talking about individual stocks, but previously, just a moment ago, we were talking about dividend stocks. So dividend stocks tend to pay out every month, every quarter, or every year. Now, the difference is we've got individual stocks. And what is an individual stock? You have to understand this. Individual stocks is you tend to buy, hold, and sell whenever you want to. So these stocks don't pay out a dividend. They make a very clear choice saying like, okay, you can buy our stock, saying you could invest in our stock, but you have to do the valuation. So you have to wait for the company to grow in value, and the moment it grows, you can sell off the stock. And in the end, it's just a game of supply and demand. It's as simple as that. So in this case, I'm going to talk about the stock Tesla. Tesla, if you want to buy one share of Tesla, it's valued at $1,544 for one share. And the interesting part is this. You have to see if this company is actually valued at this point. Now, that's the first step. Is it valued at this point? If the answer is yes, and you believe that Tesla will grow over time, then if you buy one now and Tesla grows over time, for example, in 3 or 5 years' time, they'll develop the new car that is completely electric. Oh wait, they already have that. But so let's pretend that they develop a new car that everybody can buy, and all of a sudden the company, each share of the company is valued at 2,000. Then yes, you can sell off the stock for $2,000. And all of a sudden you've got $466 in profit from that stock. Now, of course, you've got the management fee and such, and the cost, transaction cost. But yes, all of a sudden you have $400 that you could sell off, and that's your profit. Now, you have to see like this. What does the supply and demand idea apply to this? Well, like I said, Tesla could issue, for example, 100 shares. Say, let's just pretend, okay? They have millions of shares, but let's pretend they have 100 shares. Now, over those 100 shares, if you offer to the stock market saying, like, hey guys, I got a share of Tesla to sell. Anyone who wants to buy a Tesla share? This is how that works. Now, you could have on the same day somebody says, I want to buy a Tesla share. I'm looking to buy a Tesla share at this price point. Let's just pretend that. Now, they could buy, this is why the supply and demand, you supply to the market, you supply your share of Tesla to the market. And then, of course, the stock market will connect you to a buyer, somebody who wants to have that share. And this is how you sell it off. So let's pretend that you bought it for $1,544. You bought that share. And in 3 years' time, you're offering that share, that same share, to the marketplace, to the stock marketplace. And somebody's there waiting. I want to buy a stock market price. I want to buy a Tesla share for $2,000 because that's what the stock market says right now. It says it's valued at $2,000. So I want to buy one at $2,000. Now you could say like, I bought it at $1,544 3 years ago, and if I sell it now, I will make a nice profit. This is how the individual stock market actually works. As simple as that. Now, of course, at least I'll tell you this, if I want to buy 10 shares, I will have to have $15,000 lying around. No, I don't know about the average beginner investor. Most likely you don't have $15,000 lying around. And if you do, is buying 10 shares of Tesla a good idea? And that's always the first problem. Now, I'll get to that in a bit, okay? Now, Tesla is a great company because Tesla is creating new technology and technology for mankind to use, because they're just building electric cars, which is kind of like this, it's kind of the future, right? But yeah, okay, so Tesla, it's a good choice. But what is even a better choice, even in crisis times, is this. Have you taken a look at Amazon stocks? If you want to know, Amazon stocks currently trade for $3,200. Yes, that's a lot. And if you take a look at the graph of Amazon, you'll see that the graph is growing exponentially. This is why people keep saying, oh, Jeff Bezos is the richest man alive. It's not that he owns the money right in his pocket. It's not in his pocket right away. But the company is valued at a certain price, and the company is his, of course. And the stock price of each share is skyrocketing high. Why? Because in the situation that we are in right now, everything is growing as well. And the demand for Amazon helping out is huge. This is why I also do individual stocks, because sometimes it's just interesting to pick a technology company saying, oh, they are doing a great job. They are doing a great job, so I'm just picking them. Now, I'll tell you this, I don't own tens of thousands of these shares because I don't have that amount of money. And then if you don't have that amount of money, what do you do? And yet you would like to invest in these kinds of companies, in technology, in e-commerce. You do want to invest in these companies, so what do you do? And that brings us to the third investing method in stocks. And especially for beginners, this is a very good one. And the third one, of course, is index funds. Now, I love index funds. Why? Because index funds are so easy to start with, and you can invest in, for example, a sector called the technology sector. Then, of course, there are tens of hundreds of thousands of companies combined in a certain index fund, and a manager will take care of that. And of course, if one company is struck by the crisis, that doesn't mean that all the companies have to be struck by the crisis as well. And that's the interesting part. Now, one of the most interesting index funds is the Vanguard Total Stock Market Index Fund Admiral Shares, which is the VT6 index fund, which is a very interesting one, because if you take a look at this fund, for example, it's currently traded for $78, and of course, and the interesting part of this index fund is they cover over 3,000 companies. And that's the interesting part. Because there are so many companies, the interesting part is the only thing what you could do in this case is you either just, if you have that $15,000 lying around or that $10,000, I'm not saying if you have, but what you could do is you buy and you hold. That's the only thing you do. And what you could do is wait 30 years or 40, depending on how old you are. If you're only 20 years old and you want to retire at 60, you buy and you hold as long as you can, and you just wait it out. Most likely, this stock will have grown hugely over time, because those 3,000 plus companies have all improved most likely. This is why this is just as easy as that. You just buy and hold. Now, that's one strategy. If you don't have a strategy, then that's the best way. You just buy and hold. But the biggest problem that could come across you, as well as all those 3,000 companies, is that if we are struck by a certain crisis and we're all locked down inside, what happens then? Boom. It goes down. And to prevent from that, this is what I also teach my students. Instead of only buying and holding, you buy and hold. Take a look at this. This is what I teach my students as well. You buy and hold. You buy and hold. You buy and hold. You buy and hold. What this strategy is called is systematically buying. You buy each month, and every month you're holding, 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 holding. So instead of just spending $10,000 or $15,000 at one time, and which most likely you don't have lying around as cash, what you could do is, I don't know how much you have on your bank account, but what you easily could do right away, starting from today, is each month just use $100. Use $100 to buy this stock, to buy this index fund, VT6. You just buy for example, $78. That's what you could do. Then you have one share in this whole fund. Now, the interesting part about index funds is this. You don't always have to buy one share. You can buy 1.3 shares. You could buy 2.5 shares. You could buy 3.3 shares. This is the interesting part about index funds. Whereas shares of individual stocks, you always have to buy the full price. You have to always buy either one share or 2 shares or 3 shares or more shares. And when you sell off, you also have to sell off 1 full share. In the case of index funds, you select the amount that you want to sell or buy in amounts of money. And based on the amounts of money, they will give you a certain ratio on, okay, this is, so you're trying to buy for $100, okay, you'll get a little bit more than 1 point some money share, 1 point behind the comma. That's what you'll get. And this is why, if you just buy this share of $100 every month, is what you could do, starting from today. Now, the moment you get your promotion, for example, it's like, hey, you know what? All of a sudden, I can spend $200 per month. Well, why not just increase your stock investments? And all of a sudden, you're investing $200 per month. And that's the interesting part. So this will just grow along with your investments. And then the moment you're done working, you're thinking, you know what? I'm 60 years old. I don't want to work anymore. Take a look. What your strategy has become: buying, holding, buying, holding, buying, holding. Now, you don't have to buy $15,000 right away. You only have to buy 100. All the money that you have left, you can just invest. And it will grow over time. Because now it's currently $78, but you didn't have more than 100. So yes. And so let's pretend that in a year time, this index fund has grown up to 150. So it doubled, for example. Let's just pretend that, okay? Let's pretend it doubled in a year time. And you'll be like, oh man, last year I could have bought, 1 point so many shares. Now I only can buy 0 point so many shares with that same $100. Oh man, I should have fill in the blank. But it's not about that. You got to really understand like this. You only had $100 to invest. So don't talk yourself into the deep pit saying like, oh man, I should have. No. If you start today, that's already the I should have overcome. That's already the great part. You should always overcome the hardship. Just start today. That's the biggest thing. Now the interesting part is this. This is an index fund that I like to invest in, but there's another one that I would like to show you. The BlackRock Global Funds is outperforming the index, which is something that is very important. The moment you want to select a certain fund, the fund, it always needs to outperform the index. What do I mean with that? So the moment you have a certain index, if this is the line of a certain stock, you always have a line of an index as well. Now, in most cases, you'll see that the index is moving just like the actual line of the index fund that you're buying into. Now, the interesting part is this. Your fund should be outperforming this index. That just says, hey, this fund is doing a great job, not only now, but over time as well. And this is the most important thing. If you want to be making money on the stock market and you want to have this stock perform well over time, even in crisis time. So even if the market is falling, it should still be outperforming the benchmark. It should still be outperforming the index. It should be still outperforming the category. It's always important. That's just like trying to bet on a horse that is winning all the matches. The horse has won the previous 10 matches. All the matches. All the matches. All the time. Which horse should you bet on? On the losing one, which is, not even outperforming anything, which is always below even the index? Which horse should you be betting on? The green one is the benchmark. The blue one is your winning horse, which is winning all the time. And the red one is the losing horse. Which one should you be betting on? Yeah, most likely the blue one because it's winning. These are the 3 investing methods that you could start off right now, today. If you're a beginner investor and you would like to start off with dividend stocks, great idea. But dividend stocks, remember, You're not doing it for the $1 at the end of the year. You're doing it for over time value and equity grow. If you have more money lying around, you think, hey, you know what, I want to invest in individual stocks, absolutely pick the great ones that will always grow even in crisis times. And of course, if your budget is slightly lower, of course, buying into index funds, the VTSEX, and of course the BlackRock Global Fund, the BlackRock Global Fund index funds, these are great ones that will outperform the index at all times. And this is how you should grow your money over time. And that's a great way. And I hope you liked this video, of course. If you liked it, of course, be sure to hit that like button as often as you can, but actually just say, no, you should like the video only once. Hey, thank you very much for watching today's video. If you liked the video, of course, be sure to hit that like button. That's the way how we grow our community, of course. If you're new to this channel, be sure to hit that subscribe button. And of course, if you want to be notified every time a new video comes out, be sure to hit that notification bell as well. Thank you very much for watching today's video, of course, and I'll see you on the next video. Happy investing. Bye-bye.